So, mortgage interest rates just hit 3.69% for the first time since 2022. And you're seeing some of this in the headlines, you're seeing this on YouTube and on TikTok. But here's what they're not telling you: this actual interest rate drop might be the worst thing that could happen to unprepared buyers and investors, specifically if they don't fully understand who qualifies and how to take advantage of it. I'm going to explain exactly why in this podcast episode. But if you're thinking, great, now I should buy, you're probably making the first mistake that's going to basically cost you thousands of bucks. And here's what most people don't understand: low rates aren't automatically good news. They are, and they can be good news, and they're good if you know how to use them. And right now, I'm watching people make decisions that I think are going to haunt them for a long freaking time, particularly like next 3 to 5 years. I'm going to share with you exactly what I'm sharing with my clients about what's actually happening in this marketplace and why rate drops are creating a bit of a trap for the unprepared people, and the 3 things that you need to do in the next 60 days if you want to come out ahead. No fluff. Let's get right into it, and let's explain why everybody is celebrating and what's going on. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadden, and I'm your host. I can't wait to get you into the flow. Here's what you think happened. You think the Bank of Canada is about to cut interest rates and help buyers, or at least that's what a lot of people are thinking is going to happen in the news. What actually is happening right now is we've got this date coming up in October. Banks right now are panicking. You've heard it already in the news. There are millions of Canadians coming up for renewal. And on top of that, they're about 8 weeks away from their fiscal year ends on October 31st. That's right. Banks are businesses. Their job is to profit and make money and steal as much mortgage as they can. And some of them are desperately short of their mortgage targets. The rate cuts themselves are not part of economic policy as it relates to the BOC. So get that September date out of your head. This is what we call corporate desperation and strategy to be able to steal money and steal mortgages in a time when, well, maybe others have too much on their books. Now, here's a couple numbers that should scare you. First and foremost, variable rates jumped to 42% of new mortgage, which is the highest since 2022. It's not always a bad thing, but we need to be conscious of this. 60% of all Canadian mortgages, as we know, are renewing by 2026, and the average payment increase on renewal is $513. Pretty significant. Basically, everybody is rushing into the mortgage market right now, right when the biggest payment shockwave in Canadian history is about to hit. And if you are a first-time home buyer getting excited about 3.7 and 3.9% rates, you're focusing on the wrong number, even though it technically is a good thing for many. The right thing to look at is when these rates inevitably go up and you're stuck. Here's my take on the matter. First and foremost, if you don't know what's going on, one of the big banks recently launched one of those promotional specials, ones that we talk about from time to time that are highly restrictive. No pre-approvals, no pre-qualifications, no rate holds, no special programs. You literally have to just qualify on their guidelines to close within 30 days, which means it doesn't work for most purchases. And you must set up bank accounts and so forth with them. Now, in exchange for that, the truth is they're going to offer some pretty incredibly low rates. And again, this isn't necessarily a bad thing, but it is bait. Banks are essentially, all of them, are trying to lure in clients right now because there are multiple things that most people don't know. Number one, most people renew with them out of pure laziness. So your bank is basically going to say, like, hey, go see what you can get, come back to me, and I'll give you a cheaper offer with zero value and zero strategy, which people tend to forget the whole strategy part. And then on top of that, they know that most people will renew their mortgage. That is literally what happens. And so they're banking on the fact that you're going to stay with them and they're going to renew you at something higher because most people do that. Which means the second thing is that most of these programs are based on the assumption that they know that rates are projected to be higher at renewal time, and not just higher because you're not negotiating, but it's a more difficult proposition to get out. I had a client last month who was pretty pumped to get a 3.9% rate, but then I also showed him the math on renewal. If rates went up to 5.5%, his payments would jump about $600 a month. Now, of course, At that point, he wasn't as excited. The reason I brought this up is because there's a lot of these different types of programs out there right now with restrictions and term lengths. In fact, one I've seen really heavily advertised all over the internet is the 6-month low rate special. And if you're not paying attention to that, you might think, dang, I'm getting a 3.5 or whatever interest rate. They're not really getting into the fact that once you finish that 6-month term, well, two things happen. Number one, you have to sign up with them for the next term. It's written in their contract, which is a little bit scary. And number two, they don't have to offer you anything better than the marketplace. And number three, if rates go up in the next 6 months as they're projected to do, well, then you're obviously paying more money to do so. I think most people are completely forgetting their strategy and throwing it out the window right now instead of asking themselves the question, how did they end up in that product in the first place? And why aren't they talking to their advisor about what's going on? Now, with that being said, there are three different types of people that I'm seeing right now. And I think that most people are still making the wrong move in this kind of marketplace. Number one is the rate chaser. Again, it's not always a bad thing to get a low interest rate. So if you're that type of person, then you can take this data and run to the bank and get a great rate. Number one, the rate chaser is the first person that I think is making a big mistake. You're making the biggest purchase of your life based on a temporary marketing promotion. And I think what most people are missing here is that a 0.5% rate difference is $125 on a $500,000 mortgage. But buying the wrong property can cost you tens of thousands, and picking a program that has a significant prepayment penalty can cost you even more. A real story that I had there last month, I had someone practically yelling into the phone. I got pre-approved or approved, sorry, for a 3.8% mortgage on a $650,000 downtown Vancouver condo. Should I take it? I asked him one question: what happens to your life when the rate becomes 5.5% in 5 years? He was silent. He said, I hadn't really thought about that. The condo is going to cost him an extra $800 a month at renewal if that were to happen, which is more than most people's mortgage renewals. Now, I'm not going to say that that was a bad move to take that mortgage product. And in fact, I don't think the 3-year term is a poor decision in any way, shape, or form. But I think what's happening is that most people are not having any consideration towards what the consequence of taking said term is and what the outcome will be at the other side. A 3-year term is honestly probably a great strategy for a lot of folks who are in this flexibility stage where they don't want to take a variable rate because, well, variable rates are, a little bit less certain. We are at the bottom of the cycle. Whereas a fixed rate mortgage can be a little bit more focused. You're not seeing your payments change, but the drawback being that at the end of that term, you have to take whatever else is being offered. And if it's a short term mortgage, although you don't have to necessarily deal with prepayment penalties if you make it to the end of 3 years, which is a lot shorter timeline, you are going to deal with the renewal offers. And so, again, I think the key to this comment is that the story of the situation is the person is getting a great rate in term, but the outcome is that he hadn't really thought about what he will do afterwards and what the impact of making that short-term decision today would be. Most banks right now are offering mortgage rates and terms for a standard 120-day purchase that are within 0.1 to 0.2% on a 3-year, 4-year, and 5-year term. And so I think if you're considering right now what the impact of that rate is, ask yourself the likelihood that you'll be able to make the payment if rates inevitably go up at the end of the next 3 to 5 years, because the current rate projections, if you're looking at a market analysis, basically suggests that we'll see interest rates about 1% higher than the advertised rates today in 3 to 4 years from today. Now, macro versus micro, hard to say. Anyways, we'll see. Now, the second type of person I'm seeing right now where there's some challenges is another person that's in the marketplace, which is I'm waiting for rates to drop to 3% before I buy. I think that that's a massive mistake. I have clients right now that have been waiting since 2019 for the perfect time to get into the marketplace. Now they saw the marketplace shoot up like a rocket in 21 and 22. And if they wait now, they probably are going to do okay, but they're still paying more today than they did in 2019 for a home. And when you look at the math of saving up the money for a down payment versus getting into the marketplace, I think that's a massive decision. Now, we can argue the pros and cons of waiting in real estate. There's a valid point that you should be waiting until you're in the right position. And there's a valid point to look at the marketplace to see where it's at. But market timing is impossible. And the key that most people don't factor in is the opportunity cost of waiting. And I'm not pumping up real estate here as a consideration of just get in and buy today, don't buy tomorrow. My whole point is I think I'm seeing so many of the number two people, which is I'm going to wait to buy because I want to see what happens, which is interesting because in 2021 and 2022, not a single freaking person could wait They couldn't wait. They had to get in. They had to get in. They had to get in. There's that FOMO situation going on. The perfect doesn't exist in any real estate. If you're buying a property for yourself, after doing this for literally years, I've never seen somebody time the marketplace perfectly, but I've seen hundreds of people build equity and build wealth by buying when they're ready and the market conditions were ideal for their situation. Notwithstanding the fact that I just shared with you that we're having these low rate environments right now pre October because of the fiscal year end, knowing that we have this massive shift in 2026, meaning that we'll probably see somewhat of an increase in the mortgage rate environment, at least to a little bit of a higher average, among many other issues with what's going on in the United States. But I think the question that should be asked if you are that number two person about timing is like, what rate structure gives me the best position over the next 3 to 5 years that I'm happy with and I can live at? I think that is where someone needs to be in consideration. And that is where you want to be. You want to be considered a strategic buyer in this marketplace or a strategic mortgage holder to understand more or less how to make the best decision as a buyer or a refinance person or a investor or whatever you're doing. So here's what I'd suggest that people do in this marketplace. These are the things that you should be writing down right now. Number one, if you're a strategic person in Canada in the mortgage real estate market, you're optimizing four things. Number one, you're thinking differently than most people. You're not optimizing for the lowest payment just today. You are preparing for multiple different situations. You are using the rate drops to negotiate with your lender for better terms and not just lower rates, meaning you can actually work with your mortgage professional to negotiate better terms on prepayment privileges as opposed to just lower rates. Or let's say, for example, one bank is offering lower rates, but another one offers better prepayment penalties. You can often leverage that as opposed to just the interest rate, which can work out and be a better long-term fit for you. And I think most people are missing that side of the equation. Another factor that people who are more strategic are looking at is they understand the value of that flexibility and the premium that it's worth paying for. Think about this in 4 years. So let's say you take the 5-year fix because you're like, I don't really want to see a payment increase in the next 5 years. And let's say there's a quarter point premium to choose a lender that has a lower prepayment capability and a higher amount of flexibility to prepay the loan in general. Then that premium could be very worth paying for right now to give you the certainty for the next 5 years, but also the flexibility to exit if life changes. So I think what I'm saying overall here is that a smart strategic borrower is using the rate environment to take advantage of even not the rock bottom rate, but lower penalty options, taking advantage of higher prepayment privileges, 20% versus 10%, things like rate conversion flexibility from a variable to fixed, going with the lender that they want to go with, and maybe even just extended hold periods if that's what's important to them. But at the end of the day, I think you have to look at it like buying a vehicle and ask yourself the question, like, is there something else that's important to me that would be impactful when I'm making this mortgage decision? But I think most people are just literally getting it wrong right now. They think the goal is to minimize their mortgage payment, which is to a degree, yes, that is important. But I think the real goal for a lot of people right now, over and above that, is to maximize your financial flexibility to make decisions the next 5 years. Right now could be honestly one of the best times to get invested into money, the money markets, into real estate, into businesses. It's way better of time than it was in 2021 or 2022 to buy a business or buy a commercial property or buy many pieces of real estate. I think most people are just completely forgetting this, like the value of financial flexibility. And when it comes to things like investment properties, the rate drop piece is obviously to a degree a game changer, even though you don't qualify for many of these. But you just need to know it can help you out if you know where to look and what to look for. All right, so here's what I would break down as like my framework to making a decision in this environment. While most people are celebrating that the banks are obviously focusing on low rates before their year end, which is honestly awesome for some people, don't get me wrong. I think there's something that you need to think about. Number one, we talked about before. When banks and lenders are desperate and they're trying to fill their buckets, everything is negotiable, not just interest rates. We talk about prepayment privileges, we talk about terms, we talk about other considerations like length of term. Either way, many different factors can be negotiable when these types of things happen. And I think most people, the only thing they focus on is the lowest rate. Remember, it's like if a car is on sale, but you want the car that has the freaking sunroof, Well, typically speaking, the one with the sunroof is on sale too, but it's a little bit more than the one without the sunroof. It's the same thing in the mortgage game. And again, I just genuinely don't think most people are thinking about this. The second thing from a money perspective that I think people are completely forgetting right now in the real estate space is that everybody knows that Toronto and Vancouver are expensive. What they don't know is that while those investors are basically hemorrhaging money in those markets, there are markets where you can actually build wealth right now and start investing today. But here's the thing, it's not necessarily about just finding cheaper cities. I spend hours and hours analyzing different data from different markets and different clients that we're looking at, whether it be employment data, population data, infrastructure, and like rental demand online, and or looking at different data that supports this. But I think what's happening right now in the investment area, so the secondary markets, that most people are just looking at price to rent ratios, and they're wondering why they're losing money in this type of market right now. The markets that make sense from an investor standpoint right now, if you're investing in real estate, I know I just kind of went off on a segment, but I just felt like I had to talk about this. They have three things in common. Number one, growing employment. Number two, increasing population. And number three, a rental demand that exceeds supply. And those markets are out there right now. If you can find those three factors together, use that framework, and you can make money even if rates were to go up. Now, the third area where I think most people are completely missing out right now, but there is a strategic move to be made in this market, is those renewal wave, the renewal wave prep. Basically, remember those 60% of mortgages that are renewing in 2026? Well, the smart people and the smart money aren't just preparing for their own renewal, they're preparing to buy from people who can't handle the payment shock. And I'm already seeing that happen. So I talked about this from an investor perspective. Keep some capital aside for opportunities, businesses, real estate. When the payments increase, when payment increases hit, some people can't handle them. And if you're in that investment space right now, you should be telling people what exactly you're looking for and being ready with capital, which again is, I don't think enough people are doing this. Like, you have a refinance, you have a renewal coming up, restructure your loan, be prepared to be in a position that you could buy an investment property if that was your goal in 2025, 2026. And the thing is, the window for these things is closing. I mean, we talked about the fact that their banks are offering these promos up until October. They might not do this again until next year, and rates might go up by then. So you've got this window that you could do this today and be prepared for what happens. Now, because this episode is kind of all encompassing and I've gone all over the place, I want to talk a little bit about the truth of what's happening right now and what my predictions are for the rest of the year. I'll have a few more focused episodes on the comments that I talked about today, as far as where you should invest. I've had a lot of people reach about that, and what to do as it relates to short-term versus long-term mortgages in this marketplace. But here's my prediction, where I think it's, I guess, the uncomfortable truth of what's coming and why it probably should terrify most people. I think that by Christmas of 2025, first of all, these 3.6 to 3.9, 4% rates will be a distant memory. I believe that. I think that banks will have hit their targets, the desperation is going to end, and the rates will settle higher. Maybe it's a quarter point, maybe it's a half point. My thoughts are that by 2026, the renewal wave hits, and mid 2026. And I think that there will be hundreds, if not tens, but hundreds of thousands of dollars that will face payment increases that they're literally not prepared for. People celebrating today's low rates will be the ones crying about tomorrow's payment shock. Yes, I locked in for 5-year fixed at 1.9%, and then they're going to be super upset because they didn't prepare for it. So my question is, what happens to someone who's stretched to buy at today's prices when their payment goes up by $500 to $800 bucks a month at renewal? Now, today's prices, sorry, I mean years ago prices. I think we're going to see probably a pretty significant forced selling wave in Canadian real estate. And this will probably go on for the next 6 months, not necessarily like an economic collapse, but from people who didn't understand that the rate was not the rate that they ended up keeping. And even those who knew that was the case, they're probably just not even prepared for it. And if you're someone who's buying right now, you're either positioning yourself to benefit from what's coming by getting access to low rates and terms, or you're going to be a victim and you're going to miss out on this opportunity. I mean, there could be people who bought properties that just can't afford 5% rates, even though they got 2% rates, or, maybe even the value of opportunities is out there at 3.9 or 4.1, which is good for a lot of people. I do believe that people will be too stretched out. Either way, the bottom line is, this is not about mortgage rates. It's about whether or not you understand how the system works and how the game is going to be played. So my theory looking into 2026 from a prediction model is this. Number one, I think the rates are about as low as they're going to get. If we see it lower, could be a shock. We'll watch what happens in the US Fed because that will indicate really clearly and really specifically where the market ends up going. I believe that the renewal wave will have a financial impact. I don't know that it will actually deliberately lead to thousands of people missing out and losing their homes. So it will lead to people having less money to go around, and it will almost feel like people basically just got a decline in their salary really quickly, and they'll feel squeezed, and that will have an economic impact in the marketplace. I also believe that people who are well equipped right now, restructuring, reamortizing, getting their line of credit ready, or refinancing, are going to be in an incredible position to be able to take advantage of that period for the second or again last quarter of 25 and the first half of 2026 as well. Now, you might not get as low interest rates, but if you look at those economic factors I shared with you, you can do probably pretty darn well in the marketplace. And I just genuinely think that most people are going to miss out. At the end of the day, the 3.7 to 3.9 to 4% rates are designed to get you excited. My job here is to get you focused and prepared. And I mentioned this before, but in the next couple of weeks, I'll be doing some podcasts more focused on specific investment strategies that you should be prepared for with your mortgage that are working right now. And more importantly, some of the strategies that worked well in the high rates of 2023 that could lose you money in 2025. I do believe some of those strategies are dead and people don't even know about it, and they're completely screwing that up. Anyways, until then, remember this: low rates aren't good unless you know how to use them. And I don't think most people do. If you're the type of person looking to figure out how to use your low interest rate instead of shopping around and figuring it on your own, go down to the description below, click the link, book a call with my team and let me see how we can help you. And if it's a good fit, to structure your mortgage not only to get you a low rate, but to save you money. If you like this episode, make sure to give us a thumbs up, give us a 5-star rating on podcast or I guess iTunes, Spotify, wherever you're watching it, and leave your comments below. Do you agree with my opinions? Do you agree with my sentiment? Is there anything else that you're going to do in this upcoming marketplace knowing what's going on?